Hello to Marcus Carlson.
Hi there, Francois.
Marcus, yesterday at the same time we were saying how Greece was returning to the financial markets. How are they doing?
Well, Greece has basically made a triumphant return to international bond markets. The Greek Prime Minister says that the country's first bond sale in 4 years' time exceeded all expectations, and Antonis Samaras says it marks a decisive step towards Greece exiting its long-running crisis. Overall, Greece sold 5-year bonds for €3 billion. The demand was strong, with international investors offering more than €20 billion. Delano de Souza has more details.
The first bond sale in 4 years received considerable interest from international investors. Bond yields were at 4.95, well below the expected rate of 5.5%. In an era of low interest rates, investors are looking for high returns.
The 5-year bond issue succeeded beyond expectations. This means that the international markets, as of now, express their undisputed confidence to the country's economy, to the country's future, because they invest in this future.
Greece was the first country in the Eurozone to accept a bailout and has so far borrowed €237 billion. The country's debt stands at 175% of its GDP, and while it's currently been given junk status by mainstream ratings agencies, the idea of Greece standing on its own 2 feet after 2016 has begun to look possible. However, experts warn against complacency.
We have to remain very vigilant permanently. This is no time for complacency, but it is a symbolic illustration of the fact that the Europeans have preserved their own historical construction.
Greece's return to the bond markets illustrate its tough austerity measures appear to be working, although its real economy continues to suffer. Unemployment data released on Thursday dropped to its lowest level in 11 months, yet remained high at 27%. Meanwhile, anti-bailout groups are preparing rallies on Friday during German Chancellor Angela Merkel's official visit. She's seen as the main backer of harsh austerity measures imposed on Greece.
The Greek bond sale has also been welcomed by the head of the International Monetary Fund. Christine Lagarde said the sale was a step in the right direction for Greece. Lagarde was speaking ahead of the IMF and World Bank spring meetings in Washington, D.C. this weekend. The meeting brings together ministers and officials from around the world. And in the closely watched briefing, Lagarde also said that she was confident that Ukraine would get financial aid soon. Our correspondent Lorna Shaddick has more on that from Washington.
Along with the cherry blossom coming into bloom, Christine Lagarde's annual press conference at the beginning of the IMF and World Bank meetings here in Washington, D.C. is a sure sign that spring has sprung in the US capital. And this year, all eyes were on the topic of Ukraine. One Russian journalist asking Ms. Lagarde if she's confident of the success of IMF funding for that country. She replied that the IMF wouldn't enter into any such program if it wasn't confident that it would succeed. And she says she hopes the $14 to $18 billion worth of potential funding for Ukraine will help it to get back on its feet and become independent financially. She was less positive, however, on the topic of IMF quota reform, indicating her disappointment at the US Congress's failure to adopt an overall overhaul of the structure and governance of the IMF. But she said she will stick with Plan A and attempt to persuade lawmakers here to adopt that in the long term. And overall, she backed up her chief economist Olivier Blanchard's presentation of the World Economic Outlook on Tuesday, saying that she too sees a recovery taking hold overall globally, particularly in advanced economies, which are turning the corner, but said that emerging markets, although slowing down, will still be the engines and motors of growth.
Speaking of emerging markets, a new batch of trade figures from China is sparking fresh concern about the world's second biggest economy. Imports to China dropped by more than 11% in March in comparison to the same month last year. At the same time, exports from China fell by almost 7%. It was the second month in a row that exports fell in China. Both figures are highlighting concerns that the Chinese economy is heading for an economic slowdown and potentially job losses. Now, investors, they seem to be shrugging off that weaker than expected data out of China. We're seeing some red figures in the US stock markets this session, but Those analysts, they are saying that these drops are more closely linked to investors bracing for a number of major earnings reports later this week rather than the Chinese trade data. As you can see here, the Nasdaq taking a real hit this session. Despite the successful Greek bond sale earlier, European shares also closed lower, with the FTSE in London bucking that trend after the Bank of England kept its benchmark interest rate at record low levels. Let's take a look at some of the shares in the spotlight during European trading. Here in France, shares in Carrefour were down 0.6% at the close. It came even as the world's second largest retailer reported a near 4% fall in first quarter revenues to 19.8 billion euros. The fall came even as Carrefour said sales grew at their fastest pace in 2 years between January and March in local currencies, but falls in emerging market currencies meant that revenues fell when they were transferred back into euros. In the UK, meanwhile, shares in Marks & Spencer took a bigger hit and they ended 3% down. Concerns about profit margins were seen to be creeping in towards the end of the session. It came even as the retailer posted rising sales in the quarter that ended on the 29th of March. Food sales did well as usual, and rising clothes sales also sparked hopes that a turnaround plan is helping M&S. I'll bring you more business news in around about an hour and a half. For now, though, it's back to you, Francois.
All right, many thanks for that, Marcus Carlson. Time now for sports. We're joined by Dan Levy.